And Sasol is back in the black. The petrochemical firm has posted basic annual earnings per share of 10 Rand 60. That's from a loss per share of close to 70 Rand previously. The swing is as a result of higher chemicals prices, tighter cost controls and lower asset write-downs. Sasol also benefited from a 4.3 billion Rand payout from Transnet after it claimed in a legal suit that the state-owned logistics firm had overcharged for oil transportation over several years. Despite the improvement, the company has once again decided to skip dividend payments. That's as its net debt remains above the $3 billion cap it stipulated in its dividend policy. And joining us now for more insights on the company's performance is Walt Bruns, CFO of Sasol. Walt, thanks so much for your time this afternoon. So the group coming along well, but are these numbers sustainable, right? Will we continue to see such growth moving forward, considering that some of the factors that boosted growth as well were once-off items that came through, and we are still dealing with a tough macroeconomic environment?
Yeah, thank you, and good afternoon to your viewers, and thank you for having me on the show today. I think the most important metric for me, and you've already alluded to it in your intro, was the free cash flow number that increased by 75%. Our focus is very much on using that cash to deleverage the balance sheet. Mm-hmm. We believe that will de-risk our balance sheets and also the risk that we're currently trading at. And we're putting that money into our revolving credit facility at the moment. So similar to how you and me might do it if you had cash on your balance sheet or in your bank account and you owed money on your home loan, mm-hmm. you would put it into your home loan and have access to it later. That will help us to manage that risk. So it's not an easy situation. I mean, if I looked at how oil traded this year, it went as high as almost $90 a barrel, as low as 60. It settled somewhere in between, and we expect that volatility to continue. The important thing is to take back what's in our control, and we believe cost, capital management, achieving our volume targets are all things that we can do and not dependent on the macroeconomic environment. And that's, the focus of this executive team and the broader team Sasol.
And let's zoom in further on those cost control measures and how you've managed to keep cash fixed cost increases below inflation.
Yeah, so I think it's a combination of items. I think our biggest cost item on the income statement is labor. There we reduced headcount by 3% as we focused on some operating model changes that we announced last year, and also a vacancy freeze that we introduced. Additionally, we're focusing on our utility costs. The more power that we can produce ourselves, the lower we need to pay over to Eskom. That also helps with our renewable energy aspirations, where you would have seen we've announced now that we've signed north of 900 megawatts in South Africa, of which quite a big a portion of that is already online. Mm-hmm. So that helps. We just, I think, being more mindful of costs. We try to apply this owner's mindset with our organization, that we manage the cost as if it's our own. And it seems to be resonating with the organization and helps to certainly keep the cost down.
Let's look at some of the divisions and what's been playing out there, starting with the chemicals division. I mentioned at the top that higher chemicals prices have given the company a bit of a boost. Just zooming in further there, talk to me about what's playing out between the chemicals Africa division and, your international chemicals division.
Yeah, certainly. I think on the chemical market certainly remains tough, and so the price improvements that we've seen have come with a lot of hard work from our colleagues in marketing and sales to look at where we sell our product, who we sell our product to, and how do we optimize that channel mix appropriately. I think we're really encouraged on the international chemicals side. We had almost a 40% improvement in our adjusted EBITDA and achieved north of $400 million there. That didn't come without some sweat, and so we had to, obviously, we've announced some mothballing of assets, further cost control there, and so, slowly but surely, we're starting to see the benefit of some of our initiatives. In the chemicals Africa space, there we also saw a basket price improvement, as we look to reallocate some of the volumes away from certain regions. Costs were slightly higher than what we would have liked, but that's a pull through from some of the mining costs that gets charged through the value chain as we bought in more coal and reduced own production just to maximize on quality.
And on the Chemicals America division, you touched on how you've been mothballing some assets. There was also, I think, at the Capital Markets Day, I think my colleague spoke to Simon, and the group was in the process, of course, of turning around that unit, and there were talks of potentially listing the Chemicals America unit. Is that still an option?
Yeah, so it would be broader than just Chemicals America. It would be international chemicals, so it includes our Eurasia businesses. No, I think it's certainly an option, but for right now, we don't believe we would get fair value for those assets. So, our plan is to sweat those assets as much as possible. We achieved, as I said, a 40% uplift in earnings. We're guiding for another 10 to 20% uplift in the following year, and culminating really in FY28, where we expect to be between $750 to $850 million in EBITDA. When we're in that position, that gives us a lot more, it's much more value accretive. And, we may look to do something like that, or partner with somebody else to create a bigger international chemical business. But, right now we want to get some runs on the board and make sure that we are the best owner of those assets and deliver value to our shareholders.
Another factor that boosted the overall performance was that we saw impairments coming in lower during this annual period. But I'd like you to touch on what's playing out in Secunda. It seems like you are warning that more work has to be done there.
Yeah, so I think, the impairments are kind of, if I look at the results, I mean, it's never nice to say that they've improved significantly because you had much worse impairments last year. So we impaired almost 75 billion rand of our assets last year. A big portion was in our Chemicals America division, as you've alluded to.
Yes.
Secunda, the liquid fuels portion of Secunda. So Secunda is made up of both the liquid fuels and the chemicals portion. If I look at the two together, they're still significant value in use from them, but just because of the way we account for the different cash generating units, the fuels business is under a bit more pressure. The comment I made was more around, we have to further develop the plans we have. We've identified the plans, we've defined the plans, but we just need to start implementing more of them before we can bring them into the impairment calculation. So there is more water that needs to flow under this bridge, but we're confident that we have the plans in place. We just need to execute against them, and then together with our auditors, they will be more comfortable about the probability of achieving them, and that will significantly improve the value and use. But we did see a big uplift because of some of the initiatives we already announced on our emission reduction roadmap, where we reduced capital expenditure, our decision to not use gas as a transition feedstock, and also keeping our Secunda volumes higher for longer. And using some, market mechanisms or carbon offsets to help achieve our greenhouse gas reduction of 30% by 2030.
And as we move into, the next financial year, talk to me about where Sasol is in terms of that, turnaround plan, in terms of your strategic efforts to get the business back into shape.
Yeah, so I think, there's still. I'm excited by what more there's to come. I think, I'm really encouraged. We ended FY25 from a financial point of view on a really good footing, especially if you look at that free cash flow number. But, we still didn't deliver where we would like to operationally. So I see quite a bit of upside on the operational improvement, and Simon alluded to that in his section in terms of the destoning unit and how that will impact on Secunda productions going forward. We're in the fortunate position that people still want and need to buy our products. And, the more we can produce, the more we can convert that to revenue, and will help with the bottom line. From a financial point of view, we're going to keep our discipline on the cost and the capital. As I mentioned, working capital is a big lever for us, and just doing the basics right, month after month. You do 3 months in a row, it makes a good quarter. 4 good quarters makes a good year. And so it's nothing fancy. It's what Sasol was built and made to do, is to make fuel and chemical products, and we just need to do it more cost effective and produce more of them. So I'm excited for FY26. Obviously, there's still a lot of volatility and uncertainty in terms of the macroeconomic environment. But, at the moment, we've done quite a bit of, we've closed our hedging program already for FY26. So, we've got some downside protection there. And then also on the liquidity side, we've got almost $4 billion of liquidity between cash and uncommitted facilities. at the end of June. And then we've also recently, did a private placement with one of the big banks here in South Africa for a 5.3 billion rand bond, in which in exchange we got $300 million. So it helped us to rebalance our debt profile too, while also making sure we put more money away to help just manage this ongoing volatility that we're seeing.
And with that being said, then Walt, I guess shareholders won't be, getting that dividend anytime soon.
No, and I think we're trying to manage expectations. In May, I came out at the Capital Markets Day and said, we had a number of $4 billion. I feel more comfortable with the $3 billion net debt, excluding leases, as a target. My job for the shareholders is now to get that, get to that number as quickly as possible. We're ahead of that plan, that we shared. So, if I look at where we ended 25, we're already well on track to achieve that. And right now, my views on the Sasol share price is less around the dividend play as it is around the capital appreciation that one can get if you buy in. The share prices has certain, and it always depends which time frame you look at, but certainly year to date it's improved significantly. In April it was almost 55 rand a share. It's now closer to 118 rand a share. But we can't control all of that. It's about building that credibility through performance, delivering on what we said, and I think by the time Simon and I are done, you'll get tired of hearing about some of those mantras, but it really doesn't matter what we say, it's what we do that's important.
Yeah. All right, well, thanks so much for your time and just taking us through the year that was for Sasol. Now that was Walt Bruns, CFO of Sasol.